and welcome to Voice of Super, ASFA's podcast for the superannuation sector by the superannuation sector. We are live at the ASFA Conference 2025. It is superannuation Christmas here. We're absolutely loving it. And we are discussing so many big issues. Of course, one of the biggest issues facing this sector is the demographic change that we are all staring down, and what superannuation is going to look like in 5, 10 or 15 years. And I'm delighted to say that joining me here for the podcast, we have two leaders of two very important, very large funds in this country. Collectively, they have 2 million members. Deanne Stewart from Super and Kristian Fok of Cbus. Great to have you guys.
Thank you.
How's conference?
Great to be here. Fantastic.
Enjoying?
Merry Christmas.
All right.
It's awesome to see everyone.
So let's just talk about that demographic shift. More than 700,000 Australians are expected to retire in the next 5 years. That is a huge change for us. We are doubling the rate of retirement. When you're sitting at the CEO of a large fund, Deanne, what are the key things that you're thinking about? I mean, so many things, but what are the number one things?
It's so true. And actually, we've had to think about it ahead of time in many ways, because if you compare us to many other funds, we've actually got a slightly older demographics in our fund. So we're certainly seeing that wave of retirement happening right now. And we say you have to get 5 things right. And I won't take long, but they are 5 things. First of all, they need really good returns, because that 50%, when you head into retirement, 50% of your retirement income will come from the returns that you're getting, not just what you've contributed up to that point. So that's number one. Number 2, you have to have really good solutions. And I think the industry has got a ways to go. That solution has to be very income orientated, but also serve for their lifetime. So solutions. The third is really good help and advice, because it's so complex at that point into retirement. And that help and advice is going to grow and change, and it needs to be super scalable. We talk about how do you democratize advice so that actually you can really reach the millions, not the hundreds or thousands. Fourth is really good service, and it has to be as frictionless as possible. Members in retirement, it's their money, and they need to be able to access that, do what they need to do to live and retire well. And then finally, it needs to be really secure. So it needs to be really well governed, but also if you think about things like cybersecurity, that becomes really paramount, because they are really big lifetime savings. And so super funds need to be thinking about all those 5 things to really get retirement right.
Yeah. And Kristian, I mean, you would not disagree with any of those things.
I totally agree with all those things.
Any more to add from Cbus's perspective?
We're in a slightly different situation in the sense that we have probably a younger demographic in terms of membership. And, the nature of the industry is it's a growth industry as well. So in fact, we're still not getting enough people for the industry to come in, but setting aside that sort of demand problem, we see, the demand for construction and related workers, through energy transition, through infrastructure, as an ongoing thing. But the nature of the industry is also a little bit different. So, it's quite a physical industry. It's not one job, like you work your job and then you wait and you get the next job when you're younger. It's great. So members sort of, become wealthy early, they can save early, they have families early. But the flip side of that is because of the nature of the industry, they're forced to confront retirement, maybe not on their terms, but earlier. And so sort of like the whole experience has shifted forwards. And then superannuation becomes almost a bit of a stopgap. The other really important statistic for today, but that will change over time, is that around 60% of our members probably have a balance of 150,000, which is much better than a long time ago. But it still means that the social security system will play an important role.
We've had 3 years into the retirement income covenants. Some members are doing really well. When I say members, I mean ASFA members. Some funds are doing really well. Some are lagging. Do you think that it has made a measurable difference, the retirement income covenant, Deanne, and what changes has WARE made to try with that in mind?
I think the retirement income covenant is really critical. And I think it certainly has been a signpost for the industry as to where you need to go. And what I really like about it is that it isn't just talking about returns. It does bring in the risk and income parameters. And as an industry, we have to get our heads out of thinking about just super high growth account balances and FUM. And we have to start thinking much more about risk and income. That becomes so much more important in retirement. So retirement income covenant, it is really strong from that perspective. I'd say from an Aware Super perspective, we've been on this journey for a while, once again, as I go back to our demographics. And so we feel really pleased for where we're at the moment. What I would say that I think has been a fundamental difference for us is actually our investment on the technology side. Because if you truly want to really help members in retirement, a lot of that is going to be down to the data that you have and the technology and how you can actually really personalize retirement. Because unlike accumulation, where most 20-year-olds, not that I'm giving advice here, just essentially need to be in high growth, retirement is so different. You just heard Kristian say for some, they might be forced into retirement earlier than they want. For others, they might be working part-time in their 70s. And so your ability to really personalize that and break it down that it's what suits them, their family, their needs, technology and data are going to be really critical. So that's where we've actually spent a fair bit of time invested.
So you've got Retirement Manager, which is a big digital tool. So just explain what that does.
That's something. So we had My Retirement Planner that helped a lot of our pre-retirees plan for their retirement and get a confidence score for how well they're planning to the type of retirement they want. Now, over the last couple of months, we've just launched a digital version of what we've called Retirement Manager, which is actually focused on those just about to retire or they have retired. And it helps them work out, this is the first time in my life for many that won't have an income coming in. So how do you use what you've accumulated and turn it into your paycheck for retirement? And so it helps them work out what that income could be and how to make it sustainable. And we've projected it out to 95 years of age.
All right.
And then given them a confidence score. Now, the lovely thing there, as we've seen members play around with it for the last couple of months since we've gone live, is that 92% have actually chosen to take a bigger income per annum and withdraw more money. That's our job. Our job is not to try and retain it. Our job is to let them have a better life.
And this isn't advice. It's just information. Yeah, right. Yeah.
But it's so 92% are now choosing to take more income and live a better life in retirement. If you compare and contrast that to pre-using that tool, it was about 50%.
That's fascinating.
Huge difference in their life.
Yeah, right.
So far, so good. Yeah. I think the industry is going to need a lot more of this type of tools and advice to really help members just navigate their retirement and give them confidence to actually use that money and know that it will be sustainable.
What about Cbus there in that front?
Oh, look, I definitely, it's almost coming back to the basics. I think if you understand, particularly for our cohort, a substantial amount will be still reliant either, even in retirement or through a big chunky retirement on Social Security. It's not a full replacement. For those that have got full
replacement. Do we just enough about that, by the way? Do we talk enough about stuff that...
Probably not enough.
Yeah.
I mean, the system was not designed to be a full replacement. It was always designed to have Social Security as a safety net. But the means test and everything is sort of designed for sustainability, but it adds complexity. And some interesting sort of research that's come about, and we've sort of seen this ourselves. Many members delay applying for the old age pension because it's too complicated. So they go for the superannuation, which is easy to access, but they miss out potentially on $40,000 of benefits. So for us. So you're using the sort of personalised sort of journey. In our case, it's almost like, well, there's like a mass education opportunity. The other area where, and again, it's about thinking about, Social Security is not just about the individual, it's about the family. And so we've introduced an Advice Essentials Plus. So if you've got a partner that's not in the fund. We allow the general advice to be part of, the member platform, and we charge the marginal costs to expand that advice so that they get the basic sort of understanding around, how do you plan and optimize superannuation versus social security. And that's been a major hit.
Yeah. Okay. And so can I just talk about product then? So are account-based pensions still the core product, or thinking 5, 10, 15 years, we're looking more like lifetime income or pooled longevity? Where do they fit into your product set?
I would say there's a couple of things here. First of all, exactly what Kristian just said. I think when you're thinking about what the solution is for members, it has to integrate in the age pension, together with the allocated pension, together with what else. So I think it starts there. Secondly, even when you're thinking about the allocated pension, I think the industry has still got a fair bit of growing up to do, even thinking about what does the retirement allocated pension look like versus accumulation. You still see so many super funds having literally a mirror of their accumulation. But in retirement, actually you need more downside protection. Risk plays out a lot more. So even allocated pension, I think, has got a ways to go as to what does that look like and how can that be constructed. And then, yes, I think more and more you'll see as part of that smart solution, longevity to make sure that the money doesn't run out before you pass away. And so I think it will be that combination of those three things of how age pension gets incorporated in, how we really rethink what allocated pension should look like in retirement phase, and then longevity. I think you'll see more and more that combination combined with, and it's probably where we've spent most of our time up front, really good help, nudging, personalised guidance to get you to that point.
Yeah, we actually think that the existing product suite is not being utilised in its most effectiveness, right? And again, it comes down to almost people's preferences. So we have a lot of members that stay in the accumulation phase when they could opt to take on an allocated pension.
Is that preference or education?
It's a bit of both, right? And then the reason is that, one of the things that sort of gets in the way is the minimum drawdown. Now, if you've got a limited amount of money and you're sort of thinking, well, I'll need it, I want to draw it down when I need it, not, just for the sake of drawing it down, there's sort of a resistance to move from the accumulation phase where you do have a lot more flexibility, but the cost is the tax that you pay on earnings. The other issue that we see, which is this sort of, you think you're retiring, but then if you get another job, you then have two accounts. Consolidating it, because they're seen as two different systems, is complicated. You've got to roll the allocated pension back out to then roll it back in again. And so we can do things to remove some of the friction in the decisions, but there are probably, some changes, simple changes. For instance, specific circumstances where you can just top up directly into the pension itself. That might help. We've been a big advocate for saying we understand the reason for minimum drawdowns to make sure that you are using the pension, but when it becomes so low, if it's getting in the way, then maybe for the first 100,000 you don't require that.
Is that a number? Is that a number that you would think about then? 100,000? Would that be appropriate?
Yeah, we would say that's a pretty good number.
What do you think, Deanne? Exemption from minimum drawdown.
Once again, you'll get different percentages.
Yeah.
Ones according to our member base. I think we would say the two absolute necessities that I think go across the whole of the industry, first of all, is DBFOs. Sure. Really allowing scalable advice and nudging or guidance, whatever we're calling it, part one. But part two, you were touching on it, Kristian, is allow members to contribute in pension phase. Having to go back and set up a cum and set up another pension, that is just so unworkable with these retirees that are I've been working in this space for about 18 months, and when I first learned about it, I was like, what? You have to have two? That doesn't actually make sense. It is completely crazy. It was set up, apparently. That's not ASFA's view, by the way. That's not official ASFA. It's just my personal view. The origins of it, as I understand it, but I could be wrong here, was that essentially, if you think about the ATO or the government, they needed to be able to look through and actually see that the minimum withdrawal was actually, and so it was the easiest was just to completely contain it, so you didn't have extra money flowing in.
Yeah.
They couldn't easily see. Now, with today's technology and data, etc., you should be able to find ways through that. It just creates so much hassle for members.
In terms of nudging and calls to action, Guy Opperman, who's the former UK Pensions Minister, spoke to us here on the podcast, and he talked about the UK experience where they have, at very specific ages, you get a letter which is not your annual statement. It is a wake up call. It's got a special name where they're like, "Hey, you're 50. Have you thought about this? Hey, you're 55. Have you thought about? Hey, you're 60." And it with varying levels of information and alarm. Should that be mandated? Would you like to see something like that here?
I don't know about mandative, but I certainly think those practices should be shared a lot more. And there's nothing like competition and innovation. And so I would say we're already doing a number of those things. So we call them automated journeys. So at certain ages, or if we've seen certain things or they've hit certain milestones, automated essentially messages will go out to our members, and we're encouraging them to take certain actions depending on what age they are, whether it be considering the interpension phase or whether it be, for example, things like if they're heading in that age and we don't see that they've got a binding nomination as an ECO. So there's lots of different things, but my suggestion would be let competition and innovation and sharing of best practice rule versus more and more
Regulation. Let's just talk bigger picture for super 2035 to 2050. What does the superannuation landscape look like? Do we just have mega funds, or do we have small funds, or what does it look like?
Well, I think there will always be competition and always be innovation. There's definitely a role for funds that, have the sort of scale to be able to roll out, services that are specific to their members. But we know that even in the finance industry, there's new innovations that are going on. We've got tokenization of assets being encouraged overseas. And I think some of those innovations can be good. In other cases, it can be sort of like a new shiny ball and actually have some risks with it as well. But, the reason why we have been so successful is that competition you were talking about. Right? If you don't have enough of that sort of competition, then, we're not sort of motivated to keep improving and striving. The other thing is, if you think about the dynamic and how our members get information, we'll have a whole generation that it's through their phones, through social media, through informal and formal channels. We're going to have to be fighting those informal channels, and so we have to lift our game. So even if you remove the competition within super, the competition outside in terms of advice and ideas and wealth generation is here to stay, and it's just going to keep going.
And Nick, I was going to say, and I think building on that, my sense is if you think 10, 15 years out, you will still see further consolidation. And I think fewer funds. I don't think it will come down to, just a few, but I think you'll certainly see fewer because scale doesn't really matter in this game. And if you think about the investments required, just in terms of uplifting for security, risk and compliance, technology, hyper-personalization, that requires really significant commitment and dollars behind it, together with the benefits you get on the investment side. That being said, I think that there is always room for niche players or startups or innovation, and you will totally continue to see that. They have to be very sharp on where they add value versus the big scale players. I think that's how it will play out. But I'd like to see our industry also think about, is the sole purpose fit for purpose in 10 or 20 years' time as well? Because if you think about someone retiring, they're not just thinking about their super, they're thinking far more broadly about their life, their health, their financial well-being, their estate, their family. What role could and should super funds play into the future? And at the moment, it's very prohibitive as to what we can and can't do. And I'd like to see that really pull through and see ASFA take on that challenge as well.
Well, thank you very much. And certainly in terms of things like the performance test, that these are very live discussions around that too. Did you want to weigh in on that, Kristian, before we wrap up? Is the sole purpose test fit for purpose?
I think the sole purpose test does actually, create good focus. Right? I think if it's applied too rigidly, then it can stifle innovation, and it's important not to stifle that innovation. It's sort of like you need a bit more competition there, plus also you need a bit of flexibility to introduce new ideas. But it also protects you, from others. Like having a large pot of capital that could be tapped in for other purposes is very tempting. And yet the best thing we can do is to grow the economic value of our members. Hopefully at the same time, through our investments, improve the economy and the society that our members are retiring in as well. So they may not need as much money to retire in because the economy and the environment they're retiring in is better. But that's sort of a side benefit. Our job is to really, grow risk-adjusted, strong balances.
Well, it's great to chat through some big ideas. It's not dull, is it, superannuation? It's very, very exciting. Deanne and Kristian, thank you very, very much for joining us here on Voice of Super. Have a great conference. Enjoy. And thank you for listening. Do make sure that you subscribe and to stay across all of our episodes and check out the back catalogue as well. See you next time.
Thanks.